the different categories of alternative investments, starting with private capital. Then we will move on to real assets and then hedge funds. So within private capital, we have private equity and private debt. And within private equity, you can have leveraged buyouts. So that is investing in established companies. And then you can have venture capital where you're going to invest in startups or early stage companies. So let me give you an example here. Here we can take the example of Hilton Hotels, which was bought out by Blackstone, right? Blackstone is a private equity group, and they bought Hilton for 26 billion US dollars, out of which only 6 billion approximately was their investors' money. The rest they got from the banks. So it was a leveraged buyout, right? This is the leverage because they're using banks' loans or debt to buy this company out. Now, why they can do it is because Hilton is a mature company, it's an established company, stable cash flows, predictable cash flows, and that's why the bank feels comfortable giving this huge amount of investment or capital to buy this company out. And of course, the good reputation of Blackstone as a private equity fund manager also definitely helps. Now, compared to that, venture capital funds are completely different because startups are absolutely the opposite of established companies, right? They don't have predictable cash flows, they're not mature, they're early stage companies. And here we don't use debt, so mostly financed by equity of the fund. Whereas your leverage buyouts are mostly financed by debt. In the case of the Hilton deal, it was 74% debt, approximately. That was your private equity. Now, private debt, so again, with private capital, you have private equity, which we just discussed, right? And within private equity, we have your leveraged buyouts and your venture capital. Now we're talking about private debt, providing loans to these private companies. You could directly give them a loan. So usually they get loans from banks, right? But you could be a company, a fund which specializes in giving loans directly to companies with no intermediary, which means no financial intermediary like a bank. You could even give mezzanine loans. Now, what is the difference between direct lending and mezzanine loans? Mezzanine loans is, of course, direct lending, but you're not giving them a normal loan, you're giving them a subordinated loan, which means if the company goes bankrupt, the normal loans will get paid off first and then you will get your money back. Why would you want to do that? Number one, you get a higher interest rate, right? Because you're taking more risk. And number two, this type of debt is usually convertible into equity. So if the company starts doing well, you actually convert your debt into equity. So instead of directly investing as an equity investor, you want to invest as a debt investor. So even though when the company is not profitable, you keep taking your interest, because interest, of course, is not dependent on profit. But then as soon as the company becomes profitable, you can become an equity holder and start taking the profit and maybe even get a seat on the board, right? You could also provide debt such as loans to startups or early stage companies. Usually they are not able to get it from the bank. So this is similar to the mezzanine loan, that you do it for a startup and you give them debt at high interest rates. You could do it for a mature company that is going through a difficult time, going through a distress period, and you could again give them loans at very high rates of interest. So a bit like a loan shark. Now, moving on to the second category, which is real assets. with the first one being real estate, then moving on to infrastructure like bridges, roads, highways, etc., natural resources like agricultural land, commodities, and then of course you have your digital assets such as crypto and so on. Let's get into it. So real estate, of course, buildings, land, either directly buying it yourself or going through a fund such as a real estate investment trust. Now, what's happened in this space since early 2000s is securitization. Now, if you've already gone through the fixed income material, you must have already seen the asset-backed securities and how we have been creating these securities which are based on loans, and primarily the main one being mortgage-backed securities, where historically people were getting house mortgages through banks, but then what the banks started doing was they started taking that pool and giving it off to a special purpose entity which would then create securities and sell it off to investors. So now investors can invest in this asset class which is public real estate debt. So basically people's mortgages, right? That is one of them, right? You also have equity. So that's owning the real estate. It's not debt, where the other person, where the borrower owns the real estate and they're just borrowing the money from you and paying you back with interest. In the case of equity, which is your real estate investment trust, you own the property, and here you're basically getting rental primarily. In the case of mortgage-backed securities, you're just getting your payments back with interest. You can even have private, right? Commercial real estate is like office buildings, apartment buildings, and then that's equity, and you can have debt as well on the same exposure. Infrastructure, roads, dams, schools, bridges, highways. Of course, you can't go about doing this without the government. These are very, very big projects, either directly done by the government or done in public and private partnership. Then natural resources can be divided into commodities, agricultural land or farmland, and timberland. Let's get into each of those separately. Now, commodities includes soft and hard commodities. So soft like oil, hard like metals, and you've got your direct possibility of buying these assets or getting the exposure through derivatives like oil futures or gold futures, right? You can even invest in companies such as Aramco or Exxon. So let's say if you want oil exposure, but you don't want to physically buy oil, you don't even want to get into oil futures, well, you can buy the shares, the stocks of companies which produce oil and indirectly get that exposure. You could even invest in agricultural land, which comes under natural resources, which comes under real assets. So we're talking about real assets. That's the second part. C is natural resources, and so part 2 of 2C is agricultural land. Now, why would you want to invest in this? Well, the price could go up, or you could grow crops and sell them, or maybe you could use it to fatten livestock and then sell that livestock, or you could just simply own that land and lease it to the farmers, and then they can do whatever they want, whether it's livestock farming or crops. So, very interesting asset class. Then within natural resources, we have timberland. So here you're going to try and sell wood and furniture that comes from trees. And finally, within real assets, so for lack of better classification, currently the curriculum has put digital assets within real assets, such as crypto and tokens, non-fungible tokens. All right, so we've covered the first one, which was your private capital. We've covered the second one, which was your real assets, and now we are in the most sophisticated of these three, which is hedge funds. Now, why I say the most sophisticated is because there are so many different strategies hedge funds can do. So it's sort of a catch-all phrase for everything else that comes in alternative investments, right? And what happens here is that there could be a variety of strategies: long, short, equity, macro, currencies, black box. I mean, sky is the limit, right? So they've got all sorts of arbitrage going on, relative value going on. So, more on that later. But they are definitely not your traditional long only stocks or bonds. They use the same building blocks. They're either going to be dealing in stocks or bonds or currencies, but they're going to be using a variety of strategies, maybe managing the risk so well and trying to achieve absolute returns. So as a traditional long only stock manager would try to maybe beat the benchmark of S&P 500, here in hedge funds they're not going to care about that, whether the market is up or down. They're just going to try and make an absolute return for you of 50 odd percent, and that's probably a decent target for them to have. I've seen hedge funds even doing 200% per annum. So very, very interesting space. Right. So that was your different categories of alternative investments. We will stop here and then we will come back and get into the methods of how you as an investor can get exposure into alternative investments.